Hello, in this video, we're going to look at the bank balance sheet. This is going to help us understand how banks are part of the process of money creation. Now, prior to 2020, this would also be used for calculating the money multiplier, and that was based on the required reserves and banks lending out the full amount possible. However, since 2020, the Fed has decided to eliminate reserve requirements, and so we will not be calculating the money multiplier, but I will show you how bank balance sheets work and how they are part of the money creation process. So bank balance sheet, if you've taken any accounting classes, this might look a little bit familiar to you. It's going to be a very simplified version. We're going to have assets on one side and liabilities on the other. So we're going to have some sort of table. One side we're going to have assets. The other side we're going to have liabilities. So an asset is something of value. It is something that it belongs to the bank, something that the bank owns. So things that are assets would be reserves. So any cash or deposits that they keep on hand, that's an asset, something they have a value. Any loans that they make, these are considered assets. So the bank lends me money to buy a car. That loan that they own is an asset because they're collecting interest on it. It's going to get paid back. I owe that back to them. If I don't pay, they can then come take my car away from me, so it's something of value. Securities. So we haven't talked about this too much. We'll talk about this more next week in our financial markets lecture. But securities are oftentimes they're government bonds. It is some type of like private loan or government borrowing, private borrowing. So in addition to lending money to households, banks also take some of the deposits and they invest in things like securities. Any sort of physical property that they own. So if the bank owns the building that they're in, that would be an asset. Okay, so for some reason, they need to sell things to increase their reserves or meet customer withdrawals. They could sell property, they could sell securities, they could sell loans. These are all things of value. A liability is a cost or something owed by the bank. They owe it back to other people. So the biggest liability is going to be deposits. Customer deposits. This could be checking deposits, saving deposits. This is money that customers have put into their accounts at the bank that they are expecting to get back, that they plan to use to purchase things. Shareholder equity could also be a liability. So if the bank has shareholders, these are people who own part of the bank, and whatever amount that they owe them, whatever portion of the company they owe, that would be a liability for the bank. So it's called a balance sheet because both sides need to balance. Okay, so the total on the asset side needs to equal the total on the liability side. So deposits and shareholder equity is money or funding that's coming into the bank, but that money is owed back. And then the bank takes that, they leave some in reserves, they use some for making loans, they use some to buy securities, some to buy properties, and these things need to balance. So here is an example from your book showing the Acme Bank and their changes in their balance sheet. Now, just as a note, your book is going to talk about excess reserves and the money multiplier. Just ignore those parts because they no longer apply. So new deposits initially increase the deposit, which is a liability, and they increase the reserves. So in this case, let's say we have a new $1,000 in deposits. A customer says, I'm going to put $1,000 more into my checking account. So initially that goes on $1,000 in deposits and $1,000 in reserves. Now, the bank can then take those reserves and use them for other things. So maybe the bank decides they only want to keep half of that money in reserves. Okay, so they want to have 500 in reserves, and then they're going to create a new loan of $500. Okay, so we still have $1,000 on the asset side and $1,000 on the liability side. So all deposits initially become reserves, and then as the bank uses that money to buy property, make loans, purchase securities, the balance of that reserves goes down. Now, since there's no reserve requirement, technically, the bank could lend all $1,000 out. They're probably not going to do this, though, because customers do want to withdraw money. You need to use it to pay your, rent, or you have to buy stuff. You take money out. We spend our money. It's not just sitting in there forever. And if you do have a lot of money that you plan to save for a long time, 5, 10, 20, 30 years, it's usually not sitting in a checking or a savings account. So new money is actually created when a portion of the deposits are turned into loans and deposited into a new bank or a new account. Okay, so let's see how that works right here. So on the asset side, okay, so we have assets and liabilities. We'll just say that this is a second bank, just to make it less confusing. So Acme Bank decides to make a loan of $500. So this loan of $500 gets sent, let's say I borrow this for a car, and that money gets deposited into CarMax's bank account when I pay them for the car. So CarMax makes a deposit of $500 from me. And that becomes a liability for this bank, but also becomes new reserves. So new reserves for this bank. And this is a deposit. Now notice when the bank lent this money out, it did not reduce the original deposit at all. So when the bank got this $1,000, they lent out half of it. It doesn't decrease the checking account balance of the person who put that $1,000 in. It does, however, increase the checking account deposit of whoever got the loan. So now in this scenario, we actually have $1,500 in checking account deposits, $1,500 in electronic currency when we started out with $1,000. Now assume that the second bank lends some of it out. Let's just say they're going to lend half of it. So they're going to keep $250 in reserves, and they're going to make a new loan of $250. Okay. Now, this $250 becomes a new deposit in another bank or the same bank, which becomes new reserves, and so on and so forth. So the larger portion of reserves that are lent out, the faster the money supply is going to increase. Okay, the larger that money supply is going to be. But you can also see why this could potentially cause panic or uncertainty, because if half of my money is lent out and I need to spend all of it, and everybody else at the bank also needs to spend all of their money, it's like, uh-oh, that money's just not available. If you gave somebody a personal loan, so let's say this is my bank account with $1,000 in it, and my sister needs to borrow $500, I have to subtract $500 from my account before adding it to hers. So when I create a loan personally, this does not increase the money supply because my balance actually decreases. But when the bank does it, it does increase the money supply. So the money supply increases every time a loan is made. Each loan increases a checking deposit balance, but it does not decrease the account it was borrowed from. So each loan creates new digital money. No physical currency is being printed or produced. It is all digital currency. So previously, you would see that the money multiplier is 1 divided by the reserve ratio. And so the more is being lent out, or the smaller this ratio is, the greater that money multiplier would be. So no longer this is required reserves, but it would be actual bank reserves and bank loans. So for instance, if banks were lending out 90% of all deposits, and they were keeping 10% in reserves. We would get a money multiplier of 1 divided by 0.1, which would give us 10. So we would get the money supply increasing by 10 if banks are lending out 90%. So if we start out with a $1,000 checking deposit, 90% of that gets lent out, then 90% of that gets lent out, and so on and so forth. Eventually, this will create $10,000 in the money supply. Right? Okay, so we could call this a deposit multiplier, right? 1 divided by the loan ratio, that amount that's being lent out. So we're not creating physical currency, we're creating electronic bank deposits. Money is going to multiply faster when less reserves are held and more loans are made. So money is multiplying faster, people are spending more money, the economy is increasing and increasing. Now, this can cause inflation, it can lead to high interest rates, it definitely can cause some problems, and so people are concerned that too much lending, not enough reserves, could cause a lot of problems in the economy. Sometimes you may have heard of people talking about how the government can just print as much money as they want, or the Federal Reserve, which is the central bank of the U.S. And so we wonder, does the Fed actually print money to increase the money supply? Where does digital currency come from? So the Federal Reserve Bank does not actually print any money. Money is printed by the U.S. Mint. And 90% of what they print is just replacing money that's being destroyed. So it gets old, it gets ripped and tattered. And then the other 10% is to keep up with the growth in the money supply, which is largely digital. Now, the Fed actually increases the digital money supply by purchasing treasury securities or other types of assets. And so on the Fed's balance sheet, assets and liabilities, they're going to buy securities, and in exchange, they're going to give people digital currency, banks or the government or whoever. You may have heard the term quantitative easing. This is something that happened a lot between 2008 and 2022. And this is where the Federal Reserve Bank is buying a lot of bonds, a lot of other assets, a lot of securities to increase liquidity in the market. So it could be that banks are making a bunch of loans. Okay, so let's say here we've got a bank and they are making a lot of car loans. And let's say they've lent out 90% of their reserves and they realize they don't want to have that much. They need more reserves. So what they can do is they can sell some of these to the Federal Reserve. The Federal Reserve will give them cash, digital currency, and that will increase their reserve balance. So the Fed increases the money supply by becoming the owner of other securities or bonds or assets. Now, there are various laws and rules and regulations about what types of assets they can buy. It was definitely expanded after the 2008 financial crisis and even again during COVID. So their purview and the markets they're in have been definitely increasing over the last couple of decades. The Fed actually has access to unlimited digital currency to buy securities. So they can't just increase the money supply. They have to exchange it for some kind of asset. But if banks are lending out a lot of money, this will just increase the money supply without some kind of secured asset. Okay, so here is a chart. This is from the Federal Reserve Bank of St. Louis. This is showing the assets held in U.S. Treasury securities. So you could see it's fairly stable, jumps up in 2012, jumps up again, and then after 2020, it jumped up significantly. So we're at 6 times the amount we were in 2004. And so this is all due to quantitative easing. So this is securities being purchased. And then we could see this next chart here, which is looking at the money supply, or M2. So we can see how the money supply is also steadily increased. And then over here in 2020, we see this big jump over here that's going to match the big jump we see over here. So as the Fed purchases more and more securities, this is quantitative easing, they're increasing the money supply. We see this jump in M2, which includes M1, so cash, checking accounts, digital currency, and savings accounts. Okay, so here is a practice example you can do. Draw a bank balance sheet using the following information: $30,000 in checking deposits, $10,000 in reserves, $20,000 in loans, $20,000 in shareholder equity, $20,000 in property. So you should have assets and liabilities, and they should balance. Then I want you to think, if all banks are lending at the same rate, what would be the value of the deposit multiplier, and how much would the money supply increase? So you want to figure out what percentage of deposits are being lent out. So pause here. Okay, let's go over the answers. Oops. Okay, so we're going to have assets and liabilities. Okay, so $30,000 in checking deposits. That's a liability. $10,000 in reserves. That would be an asset. $20,000 in loans. That would be an asset. $20,000 in shareholder equity. That would be a liability. And $20,000 in property. That would be an asset. Okay, so number 2, the deposit multiplier. Oops. The loan ratio, they're lending $20,000 out of $30,000. So 0.67, they're lending 2/3. And then the reserves would be 0.33. Okay, so 1 divided by 0.33, we're going to get a money multiplier of 3. So in this case, our $30,000 in deposits times our multiplier of 3 means the money supply will increase by $90,000.